Welcome to the daily update, where I'll go over the action in the market for Tuesday, May 20th, and we'll see how things look for Wednesday, May 21st. Kind of a sleepy day, below average volume. Market's been kind of going sideways, at least through a lot of the daily sessions. We had a slight up day on Monday, slight down day on Tuesday, and it's a market that's looking a little bit tired right now. So it's not really a surprise that some folks may be looking to lock in some profits. Now, that's what we're going to be watching, though. When we get to the point where we're really overextended to the upside, which we have been for over a week now, and then we just keep going up, that shows a strong market. Okay, now that it looks like we're seeing a little bit of weakness coming in, what's the character of that weakness going to be? For right now, through Tuesday's session, it looks like we're holding up fairly well. There are times when the market can consolidate or wear off some of these overbought conditions by going along sideways, having slight declines. That's the sign of a healthy market. If we start to see some more conviction to the downside and lots more selling, then that could change the overall character of the market. So that's what we're trying to balance right now. And it's still looking healthy to this point. All right. So right at the open, we did have a lower open. The futures were negative. And then we just chopped along the daily pivot. One thing that we haven't been seeing for the last number of sessions is this gyration that usually takes place right at the open. You have people that put their orders in before the market opens, maybe the evening before. They're not able to watch the market all the time and they buy or they sell. That usually produces some imbalances, which can make for some really wide price swings. We're not really seeing that, at least now, but it could come back at any time. And it's more strange to see just kind of a flat open as far as price movement right after we start the day each day. Usually there's some kind of swing, then things settle down, then the smart money comes in later and decides if they want to buy or sell or do nothing. But we just chopped along the daily pivot at 59.43. And we did decline, so we did see some selling coming in, but we found support at S1 at 59.17. And then this is encouraging. We saw some late day buying that came in, and it helped prices to climb back up, and we closed slightly below the daily pivot. So we really didn't go anywhere during the day, but we could have. We could have really shifted lower. Well, we watched the close and we saw some buying coming in. We were down 0.39% on below average volume. That seems to be the norm these days. And we are still positive in the short, intermediate, and long term because we're above the 20, 50, and 200 period moving averages, even though we're still in a downtrend in the long term. We're still underneath that 4.5% level with the 10-year yield. That's what we've been watching. Stocks seem to get a little bit nervous if we go above that level. Now, there's nothing magical about 4.5%. It's relative to what's happening right now. It just seems to be a level that if we get above that, stocks really notice, and instead of buying, a lot of folks end up deciding to sell because they're afraid of the rise in interest rates. And we're just kind of dealing with news as it comes out, as it applies to the tariffs and the trade wars and just all the different things that the market has to digest. Okay, there's a lot of uncertainty now around the reconciliation bill. There was some positive, it moved from a committee out to more of the floor now with this reconciliation bill. And of course, there's bickering going on both sides right now. Some people like it, some people don't. They want changes, they want this, they want that. And that's really what Congress is supposed to do. And we'll have to see if they're calling it the big, beautiful bill. I mean, there's a lot of stuff in this. And of course, if you hate Trump, you think it's terrible. If you like Trump, you want it to see passed. But that doesn't have anything to do really with the bill itself. It's just that's more emotions feeding into what's actually happening. But there is some uncertainty right now, and the markets don't like uncertainty just because there's a lot hinging on this particular bill. Then defensive areas did outperform in Tuesday's session. We've been seeing growth really making a comeback, and that's what we want in a more positive environment. Well, it's kind of taking a bit of a rest now as defensive areas are doing a little bit better. We still have a pretty long list as far as our short-term indicators. We're still far away from the 20 period moving average, but then we have our usual charts. The StochRSI wins percent are the CCI 14 has fallen off this list. It's no longer extreme, but the CCI 20 is still on there. And the stochastics. These are usually the charts that we see when we're either going up or going down, showing that there's some momentum behind what's actually happening. But then, like I said first, the 20 period exponential moving average, that's not always on the list. And we still have some rate of change charts based on 10 periods and 20 periods that are looking extreme. And we're still quite far away from the 20 period moving average. And this is the boom indicator. And when price gets too far away from the moving average, it has the tendency to come back. And that might be what we're seeing. Now, we don't necessarily have to see a big decline for that to occur because every day that we're above the 20 period moving average, the moving average is coming up. And so if price keeps going sideways or we see slight declines, eventually it could work off this particular indicator. That's just one of the ways that things can work out. And then the slope oscillator, it's actually turning negative now. It's extreme positive, but it's rolling over and dropping below its moving average. And then we're still extreme with the short-term RSI. And then the 20 period moving average study is still looking pretty extreme there. In the intermediate term, also a fairly long list. The CMB composite, we're still up in the +3 channel with the standard deviation chart and the S&P McClellan oscillator, and now we're starting to see a little bit further out. The McClellan oscillator is more short to intermediate term, but I keep it in the intermediate term list. When we're above zero with the McClellan oscillator, then that feeds into the next chart, which is the summation index. And as long as we're above zero, the summation index keeps going up. Now we're going up based on price, but we're starting to get extreme now based on volume. I'll show you that chart as we go through it here. And then the PMO, another momentum oscillator. And most of our momentum oscillators are now looking extreme, both in the short, intermediate, and longer term. And then the studies that go along with the PMO, the TTM squeeze starting to turn more negative, even though it's still extreme positive. The bullish percent indexes for the S&P and the NASDAQ 100 were also far away from the 50 period moving average. So that's why we're overextended there. And the ultimate oscillator, no change to the overall scenario as it applies to the Fed. There's not an awful lot of focus in that area right now. They're not having a meeting. They may make speeches or do interviews here and there, and that can always have an impact on the market. But we're really not seeing all that much coming out right now. The dollar was down. We're back below 100 with the dollar, and interest rates were up, but we're still under that 4.5% level with the 10-year yield. Right now, we're coming in at 4.48%, where after Monday, we were at 4.47%. So not much of a change there. Sentiment is still positive. We're at 69, where we had been at 70. After last week, we were at 71. Where we get concerned is when we get close to that 75 level. That means that folks are getting a little too exuberant about things, and we take the position of, okay, yeah, we're positive here, but maybe the party's about over, and we better develop some kind of a contrarian view of things. We are seeing a trend both in the short and intermediate term with I use the ADX or average directional movement, and we're above the moving average. The green line's on top, and we are above 20, both with the short and intermediate term chart. So that's a confirmed trend that is positive, and we're above the moving average. That shows that it's also getting stronger. And I should put this, I should have changed this. I thought I did. It's actually above. It's above the moving average, and now we're above 20. So that's a mistake here. I kept our bias at mixed because usually if we have an up day, it's positive, down day, it's negative. But we were down, but to see that late day buying kind of gives us hope that there is some buying coming into the market. So I just decided to go with mix there, and we're still positive with the momentum. That's the number, last number of 2, 3, 4, or 5 days, just kind of taken together. And these are subjective. These are based on what I come up with, where I try to let all the other charts speak for themselves so that we don't have to put a lot of opinion into this and come up with confirmation bias. But I do, bias, another word here, I do come up with this myself, the bias or the momentum. And that's pretty much the only opinions that I come up with. I try to keep everything else really objective. Okay, we didn't have any economic reports on Tuesday, so there wasn't really anything for the markets to key off of there. There's no charts to show. We do get this once a week. This is put out by Simple Advisor. When we were really going down in April, we got down to an oversold level of 7.71, and we've just been roaring back now. We're not necessarily extreme, but we're seeing a lot of improvement currently at 69.06. The further we go up here and start to turn red, that means that we're becoming more overbought. We seem to see this a lot lately. They've been posting a lot of these different charts at Isabel Net. This is just valuation and where are we, especially when we're looking forward. And this tries to look out and base things on what are the earnings supposed to be versus the current price of the stock right now. When we get above 20, that's when an index or a sector is considered to be expensive. We're coming in at 22 now since the S&P has been going back up. When we were really going down, we actually got down a little to 20 and even a little bit below. Now that we're going back up, the price part of that equation is pushing the PE ratio back up. And then there are different sectors, the 11 sectors that make up the S&P. There are some that are either the same, staples, or even more expensive than the S&P. And this is discretionary at 28, tech, and then industrials. They're above, so they're considered to be expensive. But tech is the big area that everybody likes to get into, and it's the big growth area. So sometimes folks are willing to have that overpriced with the idea that it's going to go up and become even more overpriced. The idea of buying low and selling high. And then when we drop down below the S&P, these are the other sectors, and they're actually either right at 20 with materials, but then we're seeing communication, which has really been holding up quite well, but it's not necessarily considered expensive right now. And then we have these other areas all the way down to energy. Energy had got down to 14. It's seen a little bit of a bounce now, and so it's been able to go back up to 15. We have healthcare, that's another defensive area that seemed when we were really going down in late March and into April, it was the defensive areas that were outperforming. Now that we've been bouncing back up, it's the growth areas that have been doing better. All right, then consolidated equity positioning. After we really came down and saw a lot of selling in the market, we're starting to come back up, but we're still below zero with this chart. And then the Magnificent Seven have underperformed so far in 2025. Not a real mystery there. The rest of the S&P is actually holding up a little bit better, up 4% with the S&P being up about 1% at the time this chart was created. The Magnificent Seven, they're actually down 5% as a group. And then what is the probability of going into a recession? There's a couple of ways to look at this. On the top is, do you think we'll go into a recession in the next year? And then different ways of trying to measure that. And we take the average of all of these things together. And I put the red box around this to make it a little easier to read. And there's right now the 20% probability that in the next year we'll be in a recession. And about 6% think that we're in a recession right now based on these different measurements that are taken together. So not real high probability at this point, but this can change and it can change kind of quickly. All right, then what about forecasts? Well, remember at the beginning of 2025, there were since we had a good up year in 2024 and in 2023, everybody thought the party would just continue, and so they came up with these really high projections of where they think we'll be at the end of 2025. We're coming in right around a little bit over 7,000 on the upside and about 5,200 to the downside. The median is pretty much about where we're at right now. So we're right around the 5,900 level, dropping a little bit below that now. Then developed market gold. This means countries that are developed. So it'd be like the US and Europe and especially Eastern Europe. How much gold are they buying right now? And we're seeing a lot of that going in, actually. A lot of countries are buying gold currently. Then these are the sector flows, and the yellow line is usually what we see whenever we see this chart. That's tech, and most money goes into tech because that's a growth area. Earnings sentiment has really been improving. The dark blue line, that's the US, and that's the last time I showed this chart, we were just starting to turn up, and this is really looking a lot better now compared with the rest of the world, which are also going up as well. And then leveraged long ETF assets and then inverse ETFs. And this is part of the program that I have. We use either just a regular ETF or there are inverse ETFs that are available. And it's going back to a 10 to 1 ratio, meaning that most folks are in the long ETFs rather than the blue line, which are the short ETFs. This is where you benefit when something actually goes down. And a lot of people don't know that you actually have the opportunity to do that. You can benefit, make profits when either a sector or a market does decline, and there you use inverse ETFs to do that. All right, here's the intraday chart. And this is what I'm talking about. Not the big gyration right at the open. We just kind of, okay, let's just go along the daily pivot here. We went down a little bit below it, a little bit of it, above it. We're kind of hitting 59.50 here at a bit of a resistance level, even though we were above that earlier. Then we broke lower and came all the way down to S1. That's the negative part. But we saw some late day buying and it took us back up so that we closed just below the daily pivot. This is why I'm keeping the biases mixed right now because it's the professionals who close the market. And so these folks actually came in and did some buying. And not really seeing much of a change in the intraday chart. Things were pretty much flat, which that can be okay. It's like not every day can be totally exciting in the stock market. And if we do develop into this sideways pattern for a while, where we can work off some of these really extreme readings without seeing a real substantial decline, that would end up being quite positive. All right, we're still seeing the blue line above the red line when we look at the intraday growth to value chart here. That's positive. We want the blue line above the red line. And we're trailing off a little bit here with our S&P growth to value intraday chart, but overall, we still have been going up. Now, if we see this really start to break down, that's going to change our perspective on things and our conclusion that we're reaching. But as long as this is holding up for the most part, it's tending to be more positive. So we were down more with growth than we were with value for the large caps, down more with the mid caps, and down less with the small caps. So we're seeing a bit of an improvement here with small cap growth to value ratios. We're above the moving averages and going up. That's still looking pretty solid. A little bit of a tick down, but we're still above the moving averages with mid cap growth to value. And a little bit of a decline here, but still above the moving averages with S&P growth to value. This is the one that we focus on the most. We're in a downtrend with this ratio, but the longer we stay above both of these lines, you can see the blue line is starting to turn up, but it could still take some time for that actually to give us what's called a golden cross. And coming down a little bit, but still above the majority of the rainbow when we look at this growth to value ratio, and coming down, but above both moving averages with discretionary to staples. And here's where we're starting to see the trend. We're above 20. That's the blue line here. That's a static number. And other folks that use this indicator, they may come up with 25 or whatever number seems to work for them. I have found over the years that the 20 level seems to work good for the S&P 500. So we're above 20 with the ADX. That's the dark black line here. We're above the moving average, so it's a confirmed strengthening trend. And it's positive because the green line is above the red line. We're a little bit concerned that the green line's coming down, but it is well above the red line, so it's still positive. And coming down a little bit with the green line here, we're also above 20 with the intermediate term chart. And this is the one that I focus on the most. And so we're above the moving average, a confirmed positive trend. But we continue to drop off with volume, and we're just seeing it getting pretty much lower and lower every day as they go by. Sentiment, we're still under 20 with the VIX, and that's positive. That's when we see positive annualized returns. We're also below the moving averages when we look at the VIX of the VIX. The momentum for the VIX continues to be down, but we're getting kind of extreme here with the MACD. We advanced with this fear gauge and we just ticked up a little bit here with this other fear gauge. So we saw just a little bit of fear coming back into the market, a little more defensiveness. And we really shot up here with the daily chart of the equity put call ratio. And we're starting to bounce up after becoming really extreme with the 5-day moving average of the equity put call ratio. And we're getting to a very low reading here with the 10-day. So sometimes this can mean that we might see a little problem after this. In fact, this chart, the equity put call ratio's 10-day moving average is down to the lowest level since blah blah. I'm not into this, since July 20. That means nothing because what was the context at that time? Okay, we were coming down here. In fact, they actually pointed out, and then we saw this really going up, and then what happened after that was about a 10% correction. Or, those of you that have been in the markets for a while, you remember that decline that we saw back in 2023. What I'm having a problem with is just, you know, a lot of times they'll say this is the highest level since 1974. Okay, well, what was the context at that time versus the context now? That's why I don't like these comparisons, but the chart is useful in and of itself. Now we are seeing this declining. This is the spread between risky and not as risky bonds. Now this is how the chart usually looks, and it's coming down, and that means fear is it's coming out of the bond market, and that's good. We want fear to be out of the bond market. Then on this next chart, this is an inverted version to line up with what the S&P is doing. Here is the spread chart right here, where it was really starting to show an increase in fear, meaning this version of the chart was going down. And then since we've been bouncing up, we've been going back up here. And then there's also an inverted version of the VIX here to make all of these line up with the S&P, so they're going in the same basic direction. Now, it says if you were worried about a recession, high yield spreads, that's the chart we just looked at, should be 600 basis points or wider. Instead, they're continuing to rally. This is the chart that we've been watching and has been coming down. We should be up over the 600 level. We're down around 367 right now. So, according to this chart, the bond market is not really worried about a recession at this point. Now that could change. That's why we watch these charts every day. Then we're seeing a bit of a tick up, but we're still below the band with the volatility risk premium. So we're seeing that move up just a little bit as prices have slowed down and we saw a bit of a decline there. We're still looking pretty good here with the advanced decline line based on price and volume, even though both did decline. And we are no longer extreme positive with the short-term advanced decline ratio. That's the blue line. It's coming down. The red line's coming down. That's the intermediate term advanced decline ratio, but we're still above zero. So this chart is still positive. We're seeing a bit of an improvement here. We were seeing a little bit of a negative divergence. We were going up with the S&P while this chart was actually coming down. You could still make a case that there's a negative divergence because we hit a high right about here. Price kept going up and we're making a lower high here. But since we had a down day on Tuesday and this chart actually advanced, that is taken as a little bit more positive. And we're looking better here. We're seeing more new highs than new lows. So the 5-day moving average is going up and the 10-day is also going up. That's internal strength that we're seeing there. Dropping below the boom indicator here. Now, when you look at accumulation distribution, this is positive because we're above an advancing moving average. But then there's a modified MACD that's put on here that's called a boom indicator. And it was supposed to measure how far away are we from the moving average. And sometimes it does that, but other times it just gives us a basic direction of how this is actually moving here. And we're dropping below the moving average. So if you're more conservative, you're positive because we're above a red advancing line. If you're more aggressive, you're negative now because we're actually turning down with the boom indicator and dropping below the moving average. But when we look at the Chaikin money flow, it did come down with the histogram, but the red line is still going up, so that's still positive. And we're extreme positive with the Chaikin oscillator. We continue to go above the green line. So you look at our three smart money indicators. Again, you could say this is positive, or you're getting a little nervous with this possibly turning negative. With the Chaikin money flow, we were getting a pretty high reading. Now, we had a lot higher reading before this, but other times is about where we topped out with this indicator. So you might be a little bit concerned about that. but the red line is still going up, so it's still positive. And the Chaikin oscillator, it's still going up, but when we get above this green line, that means we're getting pretty overextended. Doesn't necessarily mean a reversal, but it does mean that we may slow down. And we actually saw the vortex go up with the green line and the red line going down on a down day. And so this is showing some improvement. It's still positive, and we're declining a little bit here with our advanced decline line studies, but we're still above all of the moving averages for all of the indexes. Declining a little bit, but still extreme. We're above 80 with 80% with those stocks in the S&P above their 20-period moving averages. That's still extreme there. And we're still just a little bit below 80 with those stocks above their 50-period moving average. We declined, but we're still above 50 with the stocks above their 100-day moving average, and declined and still above 50 with the 200-period moving average study there. So here is the daily chart. Now, we were having a difficult time getting above this dashed line, which is a pivot point, which is already on the chart. So we know this ahead of time. Well, we finally broke through that. Now it's starting to act a little bit as support, and this is right around the 5,900 level. So what was once resistance, now usually some time has to pass, but not always. We are at least holding up above the 5,900 level with this pivot point. And you can see volume just gets lower and lower and lower, it seems, every day. We're coming down, but still extreme with the 20-period moving average study of the S&P itself. We're just flat underneath being extreme with the 50-period moving average study. We're still above 50 and starting to flatten out with the 200-period moving average study. And coming down a little bit, but still extreme with the StochRSI. These are the usual charts that just show we're seeing short-term conviction. Coming down, but still extreme with the Williams percent R. We're no longer extreme with the CCI 14. Coming down, but still extreme with the CCI 20. And all of our stochastics, short, intermediate, and long term, which are further subdivisions of the short-term time frame, they are still extreme positive. The force index is declining, but still above the midpoint and still above zero, so it's positive. Condition of the short-term trend, still looking pretty good here. The green line and the blue line are going up. We're extreme with the rate of change going back 10 periods, and we're also extreme but coming down slightly with the rate of change going back 20 periods. Still in the +3 channel with the standard deviations chart. Declining but still above zero with the balance of power. And then the bow tie still shows that we are in an uptrend with the green above the red and the red above the blue. Coming down, but still extreme with the CMB composite. Still positive with the go, no go with the blue bars. Still hitting the blue line here, which is the highest high value. That's still looking positive there. We're positive with the Landry light. We're positive with the proper order. We're starting to come down here and turning darker blue with the TTM squeeze. We got above this black line. That's when it gets extreme. We just really went above it, and now it's starting to pull back. This is a longer term look. You can see the really high reading that we had recently with this particular indicator. We are above the moving average with standard deviation. So that just means that we've been moving quickly over the last 10 periods. We're still above zero with the ease of movement based on 14 periods. We're still looking positive with the Arun indicator. The oscillator is above zero. And coming down, we're seeing a little bit of a negative divergence here. We had been going up with the S&P. We're seeing a little bit of weakness coming into the McClellan oscillator. But when the McClellan oscillator is above zero, which it is now, we're still going up with the summation index based on price. And then earlier I mentioned the summation index based on volume. We're getting above this red line. So this is when we get concerned about this. And this is where the McClellan oscillators short to somewhat intermediate term. The summation index to me is more intermediate to a little bit longer term. Now, the top chart, that's calculated one way, and a completely different indicator is what we use to measure volume here. I just have them plotted on the same chart. That's neither here nor there, but if we keep going up, as long as we stay above zero, we will eventually hit this red line with the summation index based on price. So getting a little more overextended with this chart and seeing some negative divergence here with the NYSE McClellan oscillator. We've been going up with the S&P, setting a series of lower highs and actually seeing some weakness developing here. But again, we're above zero with the McClellan oscillator. So we're continuing to go up with the NYC summation index based on price and volume. We're declining for 2 days now with the Swindler trading oscillator, declining based on price and volume, but they're still above zero. Momentum. One of the momentum indicators that we look at is the price momentum oscillator. We're getting above this red line. We're still positive based on price and as well as volume. Still extreme with the PMOs that are rising, even though it ticked down a little bit. We're still extreme with the buy signals, and we're starting to get extreme. The green line here is at 80, and we're at 79 right now. So if we go above that and these other indicators stay extreme, we'll see all three of these extreme at the same time, which we don't see all that often. That shows good strength, but it also suggests that the market is quite overbought. We're still neutral though with the Elder's Impulse system for the S&P. The dots are underneath with the parabolic SAR. That means it's positive. And we're starting to roll over. And if you measure this based on if we're going below the moving average, this has actually turned negative, even though the slope oscillator is still extreme positive. We're extreme when we get above the green line. And we were extreme right as we started to head into May. We saw a little bit of a pullback, and then we went even more extreme after that. So this is showing some shorter term weakness. We're also getting extreme with the MACD, but we're still positive. So looking at all of the different oscillators, rolling over with the slope oscillator, which is the chart I just showed, the TSI, which is another short-term oscillator, is continuing to go up, not quite to its blue line yet, but we are starting to look extreme with the MACD, the PMO, the PPO. We're going above this green line with the tricks, and we're already above the blue line with the KST. So that's why I have all of our momentum oscillators looking extreme positive. Rolling over after being extreme with the Copic curve. Here's a longer term look at that chart. This is right about where we see this top out, but it hasn't crossed below its moving average yet. And we're pretty much flat and slightly declining here with the Sean trend meter, but we're still in the green area, so it is positive. We're above 50 with the money flow, and we're extreme positive with the ultimate oscillator, above the advancing moving average with on-balance volume. Still looking extreme positive in the short term with the RSI. We're just a little bit below 70 here with the intermediate term RSI. The condition of the intermediate term trend based on 50 periods. Above both of the lines, the red line's crossing above the blue line. This is looking a lot more healthy now. Here's all the moving averages, and we're still plotted above all of them, but we're far away from the 20-period moving average as measured by the boom indicator, and we're far away from the 50-period moving average. And we were actually looking a little more positive, a little bit concerned after Friday and then Monday. This was actually looking a little bit more negative with the bullish percent index, but it's giving us a very high reading. And this measures the point and figure buy or sell signals inside the S&P. And this is where we were seeing some strength really being built up as we were coming up with the S&P. But now we're extreme positive. There's not a lot of room left for this to run to the upside. And going up, looking positive with the NYSE bullish percent index, and still very extreme, coming in at 85 here with the NASDAQ 100 bullish percent index, which is good. But usually when we get above this blue line, that can point to some kind of exhaustion, sometimes even a reversal. I don't have any support or resistance right now. We're far above the long-term support that we bounced up off of. And so I'm not really showing those charts currently. All right, so looking at the trend, though, the Heiken Ashi is still positive with the open candles. We're positive with the Kagi chart, positive with the Renko chart, and positive with the three-line break chart. So the trend is still positive there. Long term, ticking down a little bit with the 150 and 200-day moving averages, but we're still above this blue line, which I have marked here at 250. That's usually a good midpoint to work from. When we're above the blue line, that means we're more positive. Then we are still looking negative in the long term with mid caps and small caps. Everything else is positive. Bonds are negative on all time frames. Commodities have switched back to being in an uptrend in the short term. The dollar is in a downtrend on all time frames. And we see here staples, utilities, healthcare. They were the three areas that were up. These are defensive areas where we see laggards like tech, discretionary, and communication. They ended up being down on the day. So seeing a little bit of red and green here. Canada, another new all-time high right at their open. Healthcare had a bullish MACD crossover. That's more defensive. The Nasdaq did go down below 19.2 and then down below 19.1. Canada got above 26,000, and we're seeing, and these are areas that have really been beat up. This is another defensive area. Real estate with a BPI cross above 70. That's showing some good strength there. Here's the market carpet. You see an awful lot of red, especially in tech. When Nvidia and Apple are down and Microsoft's down a little bit, you don't see the indexes really going up. And we're seeing financials. Didn't have a really good day there. JP Morgan was up, but all the other areas, for the most part, were down. Discretionary had Amazon down. Tesla was up about 0.5%. Communication saw both Google and Meta down on the day. And we're still above the 200-day moving average with the Dow. We've been able to hang on to that, at least for now, but we're neutral with the diamonds when looking at the Elder's Impulse system, still above both moving averages with the Nasdaq. The longer we stay above it, the more this blue line will turn back up. But we're neutral with the Elder's Impulse system for the Nasdaq. Nasdaq 100 also just kind of chopping along sideways right now, continuing to be neutral with the Elder's Impulse system for the Qs. But the momentum for the Nasdaq 100 is positive and just kind of chopping along under this R1 pivot point here with the S&P 600 small cap index in between, above the 50-day moving average, below the 200-day moving average with the Russell 2000 small caps, still getting a very high reading with the RSI, and the momentum continues to be positive, but just been kind of chopping along sideways. And neutral with the Elder's Impulse system for the small caps, having a difficult time staying above the 200-day moving average with the mid caps. It's like we closed above it, but then we spent the last two sessions being below it. But this R1 pivot point seems to be providing some support. And we're neutral with the Elder's Impulse system for the mid caps, above both moving averages with the Wilshire, as well as the total US stock ETF. Financial sector was down, but it's still holding up fairly well. The FANG index chopping along sideways above both moving averages as well here. Apple was down 0.92%, still dealing with its 50-day moving average, still in a downtrend. Amazon is in a downtrend, coming down over 1%, but still above its 200-day moving average. Google is also in a downtrend. Can't seem to get back above its 200-day moving average. Meta is above both the 50 and 200-day moving averages and hanging on. It's still in a downtrend here, but it's holding up a little bit better. Microsoft, which, as I've been saying, has been performing quite well ever since their earnings report came out. They were down in Tuesday's session, but they're above both moving averages. Nvidia also above both moving averages, even though it was down. Tesla was up 0.5% above both moving averages. And the best looking chart here is Netflix. And I'm not sure if that's a new all-time high, but it's really close. Seeing a little bit of a strengthening correlation here between US and world stocks, and a little bit stronger here with the longer term correlation. Still in the low 60s with oil, and we're still in a downtrend with the dollar and actually dropping below 100 again. Looking at Trueflation, we got up almost to that 2% level. Now, this is not the Fed. This is just a company that calculates inflation. They have us much lower, underneath that 2% level that the Fed is trying to target. And we're still under 4.5% with the 10-year yield, at least on a closing basis. And we're still above the 200-day moving average with the 10-year based on price. And just still looking okay here with our growth to value ratios. All three of these are still above advancing moving averages. We're still above advancing moving average with the large caps, mid caps, and small caps. So what's the outlook for Wednesday? We're still positive in the short, intermediate, and long term. We're just going to get the mortgage applications index, and we get that every week, and it's not much of a market mover. So there's pretty much no economic data that will be released in Wednesday's session. We want to keep an eye on what's going on with the tariffs. There's a lot of geopolitical things going on as well. Doesn't seem to really have much of an impact these days on the market overall. It did last week, but not so much so far this week. Then probably the biggest economic report of the week is will be the jobless claims coming out on Thursday, as well as continuing claims. And there is crude oil inventories. I don't really cover that, even though it can have an impact on things. I don't see the connection myself, but you may disagree. Seasonality for May 21st, the Dow is negative, where we're neutral to negative with the S&P and NASDAQ. We tend to be up two-thirds of the time, down a third of the time in the week after options expiration, which is what we're going through right now. We do still see a little bit positive seasonality here during a post-election year based on the Stock Traders Almanac chart before we see a little bit of weakness after that. But things tend to hold up better. We're also going to be having this upcoming Monday, the market will be closed for Memorial Day. And then here are the pivot points for Wednesday's session with the pivot point right here in the middle. And then I try to shade the area if I get it right. I got it wrong yesterday. We go all the way up to R2 and all the way down to S2 here. And these are posted on the YouTube community tab. So the warning signs, we're still looking at longer term downtrends when we look at growth of value and discretionary to staples. But both of them are above those moving averages. The longer they stay, the more we have a chance of those actually turning to uptrends. The swing trading oscillator is still negative, and our long-term special K chart, which I go over in the weekend videos, that's still negative but improving. And that's still pretty much it. Now, depending on how you take the accumulation distribution, you might see that as more negative because we're below the boom indicator, but we're still above the moving average, and the moving average is going up. We're positive with the Chaikin money flow, but possibly getting close to a potential extreme area, and we are definitely extreme positive with the Chaikin oscillator. And the McClellan oscillators and summation indexes, even though we're seeing some negative divergences there, they are still positive, as are the bullish percent indexes, the parabolic SAR. We're still extreme with the 20 period moving average study, but we're positive with the 50, 100, and 200. Our oscillators are quite extreme now, but they are positive. Ease of movement, money flow, ultimate oscillator, and the vortex are all still positive. The financial sector is positive, and the momentum for the NASDAQ 100 is positive. So, our conclusion, we are still positive in the short, intermediate, and long term. We're positive, but we're declining from being overbought. And that's pretty much what we're seeing in the intermediate term as well. And we can, again, continue to consolidate by going sideways. That would be the best case scenario. But we might see some kind of a pullback as well. And as I keep saying it at the same time, if we do start the pullback, we'll want to watch the intensity of that pullback. Long term, we are positive because we're above the 200-day simple moving average, but we're still in a downtrend. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.